Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, I'm thrilled to be joined by investment strategist Ryan Grabinski to talk all things markets. Ryan, how are you doing today?
I'm doing well, Ross. It's always nice to be back.
Yeah, glad to have you here. And, obviously there's been a lot going on since the last time we talked. And I kind of just want to start with the sell-off itself. We're down somewhere in the ballpark of 20%, give or take. So maybe you could put that in a bit of historical context to us and kind of talk through what a 20% sell-off means to you all.
Sure. So to be fair, right, a lot of investors like to use the 20% mark as that bear market barometer. I got to be honest with you. I think we've been in a bear market for the last 6 months. If you look at what the average stock has declined from its 52-week high, it's roughly 24% currently. That's a pretty significant drawdown for a lot of these companies. One of the things that I like to kind of point investors to is if you look back to the bear market from this March 2000 to October 2002, there were 8 rallies of 10% or more within that broader market decline. So we could get these sharp bounce backs, which a lot of investors want to say is a turning point. But you have to remember that the building of a bear market is a process. Obviously, we still we still could have room to decline further. One of the things that comes up also is trying to time the market. I like to remind individuals that timing the market is obviously very challenging, and you often end up missing. You may miss one of the worst days, but you also may miss one of the best days. You often tend to be clustered around one another during these challenging times.
Yeah, absolutely. And to your point about the 2000 to 2002 comparison, I think it's easy to have a bit of recency bias. 2020, 2018, both of those bear markets were these very sharp V-shaped bottoms. So the idea that there can be another type of bear market out there might seem a little foreign. So it's a great reminder. So as we kind of process the sell-off, we just finished an earnings season, and it strikes me that earnings are actually holding up okay. That this sell-off is more, at least at this point, about kind of multiple contraction and people reevaluating what they want to pay for those earnings. How did the earnings season look to you, and what are you watching going forward on that front?
Yeah, so obviously earnings came in pretty strong. Generally, the first quarter earnings were up about 11%. Sales growth was slightly ahead of that at 13%. I think the thing that's important to watch here is that we're for one of the first quarters in some time, we're actually seeing sales growth ahead of the pace of earnings growth. So what does that tell you? That tells you that cost pressures are mounting for a lot of companies, and ultimately we're watching margins extremely closely here. Operating margins have begun to roll over. Historically, the market doesn't get into too much trouble as long as margins are rising or steady, but when they start to roll over, that's when it becomes more problematic for companies. Right now, one of the concerns that I have just thinking about going forward is that for the second quarter, we're starting to see a pickup in negative revisions from companies. The percentage of companies that have guided lower is actually above what it's been in previous quarters. And then as it relates to just 2023, the street still has an estimate of about a little above $250 a share. Our estimate is slightly below that number, so we're expecting earnings growth to be a little less than what the street is. So ultimately, we think that the street's going to have to actually come down to where we are, especially given this idea that margins are actually rolling over.
Yeah, and with all of those cost pressures you mentioned, wages, raw materials, it would be hard not to see some challenges there. So you've given us a few things to watch kind of on the earnings front as we move into future earnings quarters. If you had to watch one other big thing, what are you looking at? What are you using to take the temperature of the market and the economy?
So I think probably one of the most important things to watch going forward is the consumer. One of the ideas, or one of the things that's been baffling to me over the last call it several weeks is just the difference between what the retailers are telling you about the state of the consumer and what some of the banks are telling you. So some of the retailers are suggesting that individuals are cutting back what they're actually spending. They are switching the goods that they're purchasing to be, let's call it the generic brands over the brand name brands. But banks are telling us that the consumer seems to be in pretty good shape. So how do we square this disconnect? I think one of the things that we're looking at is revolving credit. Revolving credit is back above where it was during February of 2020, so pre-COVID, and banks are actually seeing this as significant loan growth, which obviously loan growth benefits the banks. We've developed a consumer stress indicator here, which basically takes a look at food at home, mortgage rates, and gasoline prices. And if you combine those three, the readings on this consumer stress indicator are actually at the highest level since going back to, call it, the early 1980s. Obviously, that was another period of high inflation, and so consumers are really starting to feel the squeeze here from the higher food costs, higher housing costs, and higher gasoline prices.
Yep, no doubt. And it is the consumer who drives our economy. So absolutely something to pay close attention to going forward. Well, Ryan, this has been really insightful. I want to thank you so much for your time today, and we'll certainly have you back on in the future to see how these things all develop. Thanks again.
Absolutely, Ross. Have a great weekend.